Thank you so much, Lerato, for that introduction. Good day, everybody. My name is Gugu Sidaki, and I'm a certified financial planner. And what that means is I help everyday people look after their money and to manage their money a little bit better. I'm also the founder of My Three Piggies, which is a financial literacy portal for children. This is where we teach children about the concepts of personal financial management in the hopes that they'll become financially fit adults of the future. What I'd like to talk to you about today is the basics of investing. I'm sure, as you know, I know a lot of young people know everything there is to know about a lot, and we can talk till the end of time around all the aspects of investments. But I think these 4 concepts around investment are really, really crucial. And this is the kind of information that I wish I had when I was a young individual starting out, venturing out into the world and learning about investment. And I think it would have made a massive difference to how I look after money, to how I view money, and how I view and manage investments ultimately in the long term. And interestingly, these are concepts that adults today are struggling with. And I know that if they had had this information as young people, their journeys as investors would have been very, very different. So I'd like to talk to you about saving and investing. It seems like it's basic, but a lot of individuals are struggling with the basic concepts or the difference between saving and investing. I also want to talk to you about asset allocation, the concept of asset allocation, and how much difference it makes to the overall performance of your investments. I also want to talk to you about the relationship between risk and return, why it's important to understand it, and how much of an impact it has on you and your behavior as an investor. And ultimately, I want to talk about your biggest flex, your biggest asset, which is time. And that's what you young people have today. So we'll get into it. The difference or the distinction between saving and investing is a concept that dribbles a lot of adults, believe it or not. It seems like it could be basic, but a lot of adults that I assist today in managing their money really, really struggle with distinguishing between saving and investing, when to save, when to invest, and when not to do either. And for me, I think if this is a really crucial starting point. If you can get to this starting point here, I think it'll make your investment journey very a lot easier to manage. Let's put it that way. You only need to answer 2 questions. The first is why. So what is the goal? What is the point of investing? Are you trying to preserve what you have, or are you trying to grow it, right? The why is really, really crucial because it'll help you distinguish between whether you're supposed to save or invest. The next important question that you need to answer is when. When do you need this money? Is it now, as in the short term, or is it a little further along in the long term, in excess of 5 years? Answering those 2 questions honestly solves solves the riddle. In terms of whether you're wanting to save or invest. So often I see adults with funds for their investments sitting in bank accounts, sitting in notice deposits and money market funds. And the other way around, I see them with their emergency funds sitting in shares and exchange traded funds and unit trust funds, and it shouldn't be the case. Once you understand the distinction between the 2, you'll know what to do with your investments. So savings are for now. Therefore, for short-term spending and for emergency funding, they should not be committed towards a share portfolio, unit trust funds, exchange traded funds, and the like. Investments are for the long term. If you're not going to be needing the money in the long term, it should not be sitting in your money market fund. It should not be sitting in a notice deposit, because that's a surefire way to get poorer over time due to inflation. And all that inflation is a general rise in prices overall. And if your money is not keeping up with the general rise in prices, it means you're getting poorer over time, and that's not what you don't want, and that's why you invest for the long term. So once you understand the distinction between saving and investing, I promise you that's a great start to your investment journey. The next important aspect of your investment journey is understanding the impact of asset allocation. So many people that I chat to today, right, get really, really fixated, or start to focus on trading. They start focusing on stock picking and trying to time the market. And there's a lot of apps out there that make this process a lot easier, but I'm here to tell you that it's not that simple. I used to be a stockbroker for my sins back in the day, and I can tell you for a fact that it takes a lot of effort, it takes a lot of time, and it takes skill and qualification to actually trade effectively and to make money. And for the average person, you should not be, bogged down with that responsibility of trying to pick or decide which stocks to buy in the stock market. The biggest investment decision decision that you can make is the asset allocation decision. And what that means is deciding on the mix of asset classes in your share portfolio. And what is an asset class? It's a group of assets that have similar qualities or characteristics. So, for example, equities or shares are an asset allocation, example of an asset allocation. Fixed income or bonds are an example of an asset class. Cash is another example, and properties as well. Your biggest decision is to determine how much of each asset class you should be invested in, and then let the investment managers do the rest for you. And all you need to do is just look at a simple fund fact sheet. Any good investment manager has these pie charts on their fund fact sheets where they tell you exactly who this money or this investment is intended for, or ideally suited to, and they normally have this pie chart there. So I'll give you another tip. For a young person, right, as a young person such as yourself, you should consider the top 2 pie charts in this graphic here. The older you get, obviously, the less inclined you are to assume any risk, which is why you need to start focusing on maybe on the bottom 2 pie charts in this infographic. But the biggest decision, as I said, you just need to ensure that you're in the right asset allocation, so the right mix of assets. The younger you are, the more aggressive it should be, and I promise you the investment managers will do the rest for you. And that actually accounts for 90% of the performance of your investments, which is huge. So timing the market and stock picking makes up a very small percentage of the performance of your investments, less than 10%. So you don't want to spend your time and your money doing that when the rest of it, the bigger portion of it, the 90% of it, can be accounted for through the process of asset allocation. Okay. Another important distinction to make or to understand is the risk-return relationship between assets, securities, investments, whatever you want to call them. If you're wanting to make money out of an asset, you need to assume a certain amount of risk, and again, this is a concept that confuses a lot of adults. And so often when I meet adults, they'll say to me, I want the maximum possible growth that I can get from this investment, but I don't want to assume any risk. And it doesn't work. It just simply doesn't work like that. And as you can see, I've created a pyramid for you that explains exactly what that risk-return relationship is at the bottom, at the base of this pyramid. This is where your savings products lie, right? So your cash, your money market, your bank accounts, and fixed deposits. There is no risk. There's just very little to none, actually, risk that you assume. In other words, there is no change or fluctuation in the value of your capital when you commit your funds to these products here. And in the same manner that the risk, the return that you could potentially get from the base here, so the cash product, is also minimal. So you cannot say to me that all you're prepared to do is place your funds in a money market fund, but you want the maximum possible return. It just doesn't work like that. As the higher we go up the pyramid, the more risk you then start to assume, but also the market compensates you for that. So also that means that the higher the potential return that you stand to make. So there's exchange traded funds, unit trusts, which are baskets of investments that you can invest in, and then shares become a little bit more risky compared to exchange traded funds and unit trusts, because now you have a concentration risk. So it means you can only buy 1 or 2 at a time, and the potential for making losses there is a lot higher than there is with unit trusts or exchange traded funds. The top end is where I'd like to caution all young people. I know there's a lot of excitement. I know there's a lot of talk around what's on the top end there in red. You should not be committed. The issue with the top end of the pyramid is that people tend to get very excited and very greedy with the potential risks that they can make, and they plow all of their money into forex trading, into cryptocurrencies, and all sorts of other interesting things there. And the chances of you losing money in the top end of the pyramid is really, really high. So what you want to do is to concentrate on the orange, the yellow, and the light green and the dark green areas. Get into the right asset mix, the right asset classes, and then if you've got cash to spare, then you can start dabbling into the top end if you absolutely must. So once you understand the risk-return relationship between all of these various asset classes or all of these various assets, you can avoid a lot of this. So ultimately, as a financial advisor, as a certified financial planner, my job is to try and prevent my clients from experiencing this. The the problem with this, the reality with this, with managing your own money, is that it's personal. It's emotional. Money is emotional. Nobody wants to lose money, right? So when we anticipate that we're about to start losing money, we get very fearful and we start engaging in some very, very harmful behavior. We sell stocks when we're not supposed to. We sell them at a point when they're at their lowest, and that's the highest potential for us to make a loss. And the opposite is also true. When markets are looking very toppish, they're looking hot, and there's a lot of excitement and a lot of greed that's associated with markets that are performing really, really well. People then tend to do what they're not supposed to do, which is plow more money into an inflated market, and that's a surefire way to make money. And they just repeat the cycle. They buy when stocks are high, and they sell when stocks are low, and they repeat the cycle, and that's just the best way to lose money. So ultimately, the reason why we're trying to understand the relationship between risk and return is to understand that the markets are going to fluctuate. They're going to go up and down all the time, in the short term especially. If you're invested for the long term, it really, really doesn't matter, because ultimately the trend is upwards. So in other words, the markets will creep up eventually over time. Whether there's short-term movements in the markets in the short, it doesn't really matter. In the long term, you will stand to make lots of money. It's not a guarantee, but that's generally the trend of the market. And all you need to do is just look at the performance of the JSE for the last 100 years or so, and it'll show you exactly what the trend has been looking like over the years, and speaks to exactly this. Finally, and I think I cannot stress this point enough, is that the younger you are, the bigger this asset is in your hands, which is time. The true value of investments lies in time. You can pick, oftentimes you can pick even really bad investments, but if you give it time, that investment will generally tend to make money for you over the long term. It's not in stock picking, right? It's not in trying to time the market. It's actually in getting invested to start with and staying invested. That's where the true value of investing is. And we don't need to look very far. The best example of this is with Warren Buffett. You may or may not have heard of him, but he's one of the greatest investors of all time. He's also one of the richest people in the world. And Warren Buffett is rich not just because he's a great investor, but he's rich mostly because he started investing when he was very young. He was around the age of 16, so he had great models who modeled the right behavior and got him invested at a very young age, and he stuck it out. He just consistently kept investing in the stock market from the age of 16, and he's almost in his Warren Buffett is past the age of 80, I think, and a lot of his money has come through compounding. So the money that he's put in, that has just grown consistently and made more money over time, and that's the best thing that you can do at a young age, as a young person. This is what you've got working for you right now. You don't need to come up with a lot of money to make money. You just need to come up with a little bit and consistently add to it over time, and start as early as possible and just watch it grow over time. So just to recap, I think the best things that you can do for yourself as a young person venturing out into the world of investment is firstly to start and understand the difference between, or the distinction between, saving and investing, because that's going to save you a lot of trouble down the line. The second thing that you can do, a second important thing that you can do, is understanding the impact of asset allocation, and that stock picking and trying to time the market is really not going to get you very far. It's going to get you somewhere, but not very far. It's not going to make a very massive difference to your portfolio performance. The third important thing that you need to remember is that, if you're going to take on if you want to make some money, you need to take on some risk, and that means you're going to experience some discomfort along the way. Just stick it out. Just stick it out. It'll be the best for you in the long term. And then finally, start as early as possible. Get in at this. This is the perfect age for you. Start with your 100 Rand. Start with your 50 Rand. Whatever it is that you have, get invested now and stay invested. You'll thank yourself in a decade, in 2 decades or so. And I promise you, it seems like 20 years is quite far from now, but it comes at you fast. And I promise you, you'll thank yourself in the long term. And good luck with your investment journeys. Back to you, Lerato.